Darby, Jefferies, as Chief Global Equity Strategist. Bit of a responsibility, that, isn't it? Okay, so what's going on?
Well, I think the markets took the view that whilst there was nothing directly coming out of the ECB, that there's in the background a bailout being proposed for Spain, and that's probably...
He said not to expect one, though.
Well, he said not to expect one. I guess the markets are beginning to assume that Spain, which had been very reluctant and almost in denial about needing a bailout, is now getting ready to accept one. And it looks like the terms will be relatively soft, i.e. that there's not going to be any further implementation of any austerity measures, and maybe they won't need the oversight of the Troika, which of course has been the problem for Greece's parliament to accept.
Well, you know, we're nearer to the end of this. I mean, we've got, of course, the 17th, and that's that election taking place in Greece, and that's going to be pivotal, but at least we have a timeline. But then I guess there'll be another timeline after that.
Well, there's a very big summit at the end of this month in Europe, which is supposedly going to now to round off the whole of the...
It'll be their 20th one. That would be on...
yes.
On Greece. They've had 19 already on Greece.
They have, and this one is supposedly going to come up with some measures, perhaps outlining the deposit insurance scheme and essentially bank reform and financial integration. But I think the key thing for equity markets over the next quarter is that there's still no pro-growth policies either in Europe or elsewhere in the world. We've still got fiscal contraction going on, and that's still going to temper any of the GDP numbers.
Sean, when we see what's been going on equity-wise and seen this ramp up recently, I mean, is it the view that investors are taking that, well, valuations are stunningly attractive now?
No, I think these markets now are getting pushed and pulled by futures-related trading. There's not any genuine cash buying that's going on or genuine cash selling. I think it's very much positioning by various funds on potential outcomes, and really that's just what's happening in the markets in the short term.
So we could have another leg down quite easily?
Very much so. Again, if indeed the bailout in Spain is actually a much larger figure than that's being muted at the moment, which is about 40 billion, if it comes into triple digits, I think people will start to again question the whole foundations of the Eurozone.
Oh, they are already?
Well, I think the Euro's been reflecting that, but again the key here is that the markets want damage limitation exercises, but the reality is that there has to be a whole fundamental reform of the whole Eurozone programme, and until that's in place, I think we'll still be finding that the risk-off bet is going to be the one that's being translated into markets.
Okay, so you must be underweight Europe at the moment, are you? I don't know.
We do, yes.
But then when we look at the rest of the world, we look at Asia, we look at China, you know, some of these Chinese equities have price-to-earnings ratios which are just amazing.
Well, they are. A lot of markets have seen compression in valuations. The problem is that, as I said, without any pro-growth policies, these equity valuations and earnings numbers are actually going to still be falling. So you could still be catching a knife far too early for these markets. And I think it's really going to be something in Q3 when we start to see some of these governments relaxing a lot of the fiscal policy measures. And
monetary?
Well, potentially out there.
I mean, because China's doing it. I mean, they do it through the triple R, but is that the best way? I mean, we haven't got any movement when it comes to the actual cost of borrowing.
Well, I agree with you. I think the thing that's going to be interesting this week towards the Friday, Saturday is really the PPI numbers in China. That should show another leg down in deflation in the corporate sector, which should induce some rate cuts.
That's the input prices, so that's a, you know, they give us a forward view as to what happens down the line, really.
Down the line, and also about corporate profitability. If those prices start to fall, it's pretty bad news for the corporate sector. So those numbers will still be negative, and that should put pressure on the central bank to actually cut rates. But once again, I think what's happening in the background is that markets are anticipating a coordinated form of intervention, which is why Draghi's not cutting rates now, which is why China's not doing very much, and why the Fed has probably been holding off on its own rhetoric as well.
So it's a global concerted stimulus package which will happen, is what you're suggesting. Okay, very quickly, you know, US possibly also doing the same thing. Is it now a question of when rather than if we get another round of QE? I
think within the next month you'll get a coordinated response to what's happening in Eurozone. If that doesn't happen, I think markets will start to put price in some pretty dire projections for global growth next year.
In 10 seconds, if you had to put your money in one thing, what would it be?
Well, I like convertible bonds. I think that's one asset class that's going to still do well over the next 18 months. I think it's got all the volatility hedge, it's got corporate protection in terms of the credit, and it reflects cheap equity valuations.
Thank you very much indeed.
Thank you very much.
Sean Darby there from Jefferies.